Crypto taxes. Ugh, I know, right? Problem is, if you don't do them, you could be paying way more than you have to, and who wants that? In this video, I'll be breaking down exactly how crypto taxes work, the biggest mistakes people make, and some legal ways to save money when filing. By the end, you'll know how to avoid unnecessary tax bills and keep more of the hard-earned cash that you made throughout the year. Keep in mind, while I do have degrees in finance and accounting, I am not a licensed tax advisor. Always consult with a tax professional for personalized advice. So here's the deal. The IRS sees crypto as property, not cash. That means that every time you trade, sell, or even use crypto to buy something, you might owe taxes. And that's not just selling. Mining, staking, and airdrops can all count as taxable income. A lot of people think that if they don't cash out to dollars, they don't have to pay, but that's not true. Don't worry though, there are ways to minimize your taxes if you know the rules. So stick around, I'll show you how to keep more money in your pocket while staying on the IRS's good side. Okay, so now that you've had a quick intro to some of the ways crypto is taxed, let's talk about how the IRS actually sees it. As I mentioned briefly earlier, the IRS treats crypto as property, just like stocks or real estate. That means that every time that you trade, sell, or use it, you might have a taxable event. Even if you're just swapping Bitcoin for Ethereum, the IRS considers that a sale, and you might owe taxes, really on any profit that you've made. I'll get into this more later, but it's not just about trading. If you get paid in crypto, whether from a job, freelancing, or even selling something online, that counts as income that needs to be reported. The IRS even wants to know if you received crypto for free through mining, staking, or airdrops. Here's a big one though. You have to report your crypto transactions even if you didn't get a tax form. A lot of exchanges don't send tax forms yet, but that doesn't mean that you're off the hook. The IRS now asks about digital assets on every tax return, so if you bought, sold, or received crypto in any way, they expect you to report it. So now that we know the IRS treats crypto like property, let's talk about what actually makes it taxable. Not every crypto move means you owe taxes, but some very common ones do. First up, selling crypto for cash. Let's say you bought Bitcoin for $10,000 and then later sold it for $15,000. That's $5,000 of profit, which is taxable. Easy, right? Here's where it gets tricky. Trading one crypto for another is also taxable. Let's say, for example, you swap Ethereum for Solana. The IRS treats it like you sold the Ethereum for dollars. So let's imagine you bought some Ethereum for $2,000 and swapped it for Solana when it was valued at $2,500. The Ethereum that you bought at $2,000 is now valued at $2,500 and you're swapping that for Solana. So you would have a $500 taxable gain. Your new tax basis or entry trade into Solana is valued at $2,500. Even using crypto to buy stuff triggers taxes. I know this is a bit intricate, but not everything is taxed. Buying crypto with cash and simply holding it, not taxable. Moving your crypto between wallets, also not taxable. The key is to know when a transaction crosses that line, because if it does, the IRS expects you to report it. So now we know which crypto moves are taxable. Let's talk about how much you actually have to pay at this point. This really all depends on whether your gains are short-term or long-term, and trust me, it makes a difference. If you sell your crypto after holding it for less than a year, that is a short-term capital gain, and it gets taxed just like regular income. That means that your tax rate could be anywhere from 10% to 37%, as you can see right here. The difference between the 10 and 37% is based on your taxable income for the year. You can find on websites like NerdWallet right here the differing percentages of tax rates based on your income level. Now, if you hold your crypto for over a year, it qualifies as a long-term capital gain, and you get taxed at a much lower rate. 0%, 15%, or 20%, also depending on your income level. You can use that chart on NerdWallet or something else, or you could probably find it on the IRS website as well. Now, quick pause. If you're trading on platforms like Coinbase or Crypto.com, make sure to take advantage of their tax reporting features to track your short-term and long-term gains. It can save you a ton of headaches during tax season. I'll leave a link in the description to Coinbase and Crypto.com where you can get a $50 bonus just for signing up with that link. Now, the bottom line here with reporting and knowing how much your long-term or short-term gain is, the IRS is really rewarding the long-term holders with lower tax rate. That's what you gotta make sure to remember here. So if you're thinking about selling, just know how long you've held your crypto, and then you can change the impact that it has on your tax bill. While capital gains tax applies when you sell or trade crypto, there's another way the IRS can tax your crypto: ordinary income. This happens when you just earn crypto instead of buying it. So let's start with mining. If you mine Bitcoin or any other crypto, really, the IRS treats the coins you receive as taxable income based on their value when you receive them. It's the same deal with staking rewards. If you stake Ethereum, Ethereum, and then you earn 1 Ethereum as a reward. And let's say it's worth $2,500. $2,500 is what's going to be reported on your taxable income. If you then sell that Ethereum later for more money, let's say you sell it for $3,000, you'll owe capital gains tax on the profit above your original $2,500 tax basis. The bottom line is, if you're earning crypto in any way, the IRS treats it like you're getting paid in cash. Now, how are you going to report this? If you've earned, sold, or traded crypto, the IRS wants to know about it, but how are you going to actually report it? That's where tax forms come in. First, you're going to need Form 8949. This is where you list every taxable crypto transaction, what you bought, what you sold, when you did it, how much you gained or lost. If you traded a lot, this is going to get messy fast. So keep good records, and that'll be huge to make your life a whole lot easier. The next form is Schedule D. This is where you total up all your capital gains and losses from Form 8949 and report them to the IRS. If you had short-term and long-term gains, they get taxed differently, so they need to be listed separately. If you earn crypto through mining, staking, or getting paid in crypto, that goes on Schedule 1 or Schedule C, depending on whether it was a hobby or a business. But here's the kicker. Even if you lost money on crypto, you should still report it. Capital losses can actually lower your tax bill by reducing your taxable income. So the bottom line here is reporting your crypto taxes isn't just about paying what you owe, it's also about making sure you don't pay more than you have to. So we've talked about how the IRS views and taxes crypto, but guess what? The rules are always changing, and it's important to stay updated, really, because recently some lawmakers have been trying to change tax reporting rules for certain crypto transactions. They want to stop a rule that makes decentralized finance platforms report transactions to the IRS. Here's the article where you can see the Republican side of things. This is where they want to kind of kill that particular reporting rule for Form 1099. And you can obviously see Ted Cruz right there on the front of this article. At the same time, the IRS is getting more strict about making sure people pay taxes on their crypto gains. They've started new rules that require brokers to report crypto sales to the IRS, making it harder to avoid paying taxes. Also, with the new administration, there might be more friendly rules for crypto coming up. This really could mean less strict regulations and more support for crypto activities. Now, let's talk about some common mistakes people often make when they're filing their crypto taxes and how to avoid them. One big mistake is not keeping good records of your crypto transactions. Without detailed records, it's really hard to report your gains and losses accurately, which can lead to problems with the IRS. Another common error is misreporting the type of income. It's very important to understand the nature of your crypto activities and report them correctly. People also often forget to report their really small transactions, like using crypto to buy a cup of coffee. Even a small purchase can be a taxable event, so it's really important to report them all. Lastly, failing to report your crypto held in foreign exchanges is a common oversight. If you have more than $10,000 in foreign accounts, you really may need to file a report of foreign bank and financial accounts, which is called an FBAR. Hopefully, by being aware of these mistakes, it will help you guys avoid them and you can file your crypto taxes more accurately, stay on the right side of the IRS. Keeping track of all your crypto transactions can be a real headache, but there are tools designed to make this easier. One great tool is CryptoReports. It's a professional crypto tax calculator and portfolio manager that works with all exchanges or most exchanges and cryptocurrencies. It really helps organize your crypto related reporting by importing your wallet data, managing your exchanges, and calculating your crypto taxes. It allows you to pull real-time and historical data directly into your spreadsheets, making it easier to track your investments and your tax obligations. Basically, this means that it can pull price data from particular dates and times so that you can have it within when you're having your specific transactions. If you don't know what the price was back then, it'll pull the data for you. So now that we've covered the essentials of crypto, like the taxable events and some softwares to use, let's talk about some strategies to legally minimize your crypto taxes. This is what I would call tax loss harvesting. Tax loss harvesting means selling crypto that is worth less now than when you bought it. By doing this, you can use these losses to offset other gains, which can lower your overall tax bill. The cool part, you can even buy back the same crypto right after selling it, keeping your investment while still claiming the loss. So if you plan your moves very wisely, you can reduce your tax bill and keep more of your profits. All right, so we covered a lot about crypto taxes, how the IRS sees crypto, what counts as a taxable event, how capital gains work, and even how to avoid common mistakes. The big takeaway, keeping track of your transactions is key. And hey, if you want to start diving into crypto yourself, a really popular platform for meme coins is called MoonShot. I'll leave a link below where you can actually claim some free meme coins. Just sign up with that link and click the claim meme coins button. button. If you want to buy crypto, I've got links down below exclusively for Coinbase and Crypto.com that'll give you $50 worth of crypto just for signing up using that link. If you found this video helpful, don't forget to hit the like button and subscribe for more crypto tips and updates. It really helps out the channel, and I've got a lot more content coming your way. Thanks for watching, and I'll catch you in the next one.